Hey you guys, welcome back to the show. Today we're going to talk about the easiest thing to do for investing. So it's a new year, you went out, you finally started that Roth IRA. Congratulations, it's a big step. But now you find yourself paralyzed by what you want to invest in. So rather than give you my advice, which you guys, I'm just an average Joe on YouTube, I want you to listen to Warren Buffett's advice. Warren Buffett is arguably the most famous and successful investor on planet Earth. And here's what Warren Buffett says.
If I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
It's real easy, you guys. Buy the S&P 500. How do you do that? Well, you already did the hard part. You got your Roth started. So you go out and you buy an S&P 500. Let's take a look really quick at historical annual returns of the S&P 500. Now, I understand this goes back to 1928. I don't think it's that relevant. Let's go back 30 years because most of us aren't, 95 years old. So if we look at the last 30 years, so this goes back to the first year is 1992. You guys, that's the year I got out of the Army, the year I got married. So in 1992, the S&P returned 4.46, then 7.6, and then in 94 it went down 1.54. The next 5 years were strong, averaging between 19 and about 34%. And then we hit the dot-com bubble. The dot-com bubble, in case you guys weren't alive yet, was when everything with the dot-com in its name was going public, and it couldn't grow that long, and it didn't. It died. In 2000, from 2001, 2002, it went down, and the max was about 23.5%, you guys. Finally, in 2003, it returned, and it was back at 26.38. Then we got another year of just under 9, then 3. Then 2006, we had 13.6. 2007, we barely passed go and got 3.53. And then the Great Recession, the housing collapse, you guys. 2008, we dropped 38.5%. If you weren't investing back then, that is what I explain as the most scary time ever. The banking system almost collapsed. And it was arguably the worst financial problem our country has had since the Great Depression. In fact, we got really close to having another depression. So then back in 2009, we're back to 23%, 12.78. 2011 was really flat, you guys. 2011 almost was zero. 2012, 13.4, 29.6. 2014, again, 11.39. Oh, 2015, what happened? We went a little bit negative. 2016, 9.5. 2017, 19.42. 2018, a 6.24% drop, you guys, and that all came at the end of the year. Then 2019, almost 29%. 2020, even with the pullback in March, the bear market, which actually was the first bear market in 10 years, we ended the year with 16.26. And so far this year, even though we're just barely into it, we're at 1.43 positive. Why am I showing you all these things? Because it's not always an easy road. Everybody on YouTube likes to tell you that you're going to get 10% returns on average. And over the long term, that may be the case. But every couple of years, you can see you're going to lose some money. And if you were alive in 2008 and you were invested and you saw some big numbers fall. So I want to take a look at the historical returns of the S&P 500. So let's look at the last 15 years again. So let's start right here at 2000. Well, this only goes to 2019. So let's go back to 1992 again. So it could look like the other one. Oops, 1992. So the S&P started the year off at 417. Now, just for reminders, you guys, right now we're above 3,800. But take a look, 1990, we actually finished behind. It started at 359 and it ended at 330. Let's fast forward 10 years. 10 years later, we're already at 1455, and we actually crossed 1500. The S&P crossed the 1500 point threshold for the first time, but we also ended down. Look at that, 10.14%. We had a couple years during the dot-com bubble where that happened. We didn't actually get back above 1,000 until 2002. Let's fast forward to 2010. 2010, we didn't gain a lot in the 2000s, you guys. We're still at 1132.99 to open for 2010. Now, we did have some pretty good returns there, but you can see that the highs were 1259 and the low was 1022. So it went down over 100 points, 110 points from where it opened that year. So the reason I'm showing you all these numbers is to show you that 2018 was negative, 2015 negative just a little bit, 2008 38.5% negative, 2002 23.37 negative, 2001 13% negative, 2000 even 10.14 negative. You guys, there is volatility in this index. But think about what Warren Buffett said. He said invest long term. So knowing that, what should we invest in? Well, I'm going to talk about 3 ETFs that are easy to invest in. First one we're going to talk about is SPY. This is a State Street Spider S&P 500 ETF trust. You guys, this was the original S&P 500 ETF. This has been around since 1993. This was the very first ETF. It's a huge fund. You see, it's got $334 billion of assets under management. It's got a nice expense ratio of just 0.0945%. So 9.45 basis points, which means basically on a $10,000 investment, you're going to spend about $950 a year. So pretty inexpensive. Next one we're going to talk about is the BlackRock iShares Core S&P 500 ETF. Now, you can see you can buy one share of this ETF for about $381. It's got a wonderful expense ratio of 0.03%, so $3 on 10,000. If we take a look at the fact sheet quickly here, so this has about $214 billion of assets under management. You guys, again, S&P 500, you see the top holdings are exactly what the S&P 500 has. One good thing about this is most of these funds are going to track pretty even. Third one we're going to talk about is a darling here on YouTube because it's a Vanguard fund. And I'm a Vanguard fan, you guys. Vanguard, because they are owned by the shareholders, they put their money back into saving you money rather than making money for shareholders. They lower costs. So this is a Vanguard S&P 500 ETF, ticker VOO. This is VOO. Everybody knows VOO. If you're a youngster in the investing world, you know VOO. This has, again, a wonderfully low expensive ratio of 0.03%, so $3 on 10,000. It's got $181 billion in assets under management, so not quite as big as the other two, but you guys, these are big funds. Why is that important? Why is the assets under management important? Well, you guys, because ETFs are bought and sold on the stock exchange, the bigger the fund, a lot of times the easier it is to sell the fund when you need to. Now, I'm not saying you should go out and buy and sell your funds, but let's say that you needed to sell it for an emergency and you needed to take out some money from your Roth. I'm not encouraging you to do that, but I'm saying if a dire emergency happened, you needed to. It's easier to sell a bigger fund. Some of the smaller funds you could probably sell, but you would get the same price. You would have a bid-ask spread. If you take a look here, you can see the bid here for this fund is $347.66, and the ask is $347.75. So only about 9 cents difference. In some cases, that can be dollars of difference if it's a little bit harder for these to sell. These are 3 good funds. You want to buy something for your Roth IRA, but you're not sure. Invest in the 500 largest, most successful companies in the U.S. You're going to get that with any of these three funds. All three of them are easy. They're simple to buy. You can buy them for the price of one share. And if you work on a platform that sells partial shares like M1 Finance, for example, you could buy even less than that. Now, I have a link to M1 and the Finance in the description below. If you guys want to, you can use my link. You sign up right now. They're giving you $30 when you fund the account. You do not have to use my link, but if you do, I get a little return back into my account. I put that money into my channel. You guys, you got the Roth started. Do yourself a favor. Do what Warren Buffett says. Invest in the S&P 500. It's simple. You just put money in and let it grow. All right. Hope you got something out of this. If you did, do me a favor. Drop me that like. It really helps the algorithm. Turn that button blue. Smash it. Kill it. Do whatever you have to do. I appreciate everybody. If you're not already subscribed, you know the deal. Hit the red button. Ring the bell. You get notified every time I make a video. All right. We'll see you. Thanks.